Hi, this is Jeff Cropscott, President of Cropscott Consulting Partners, and glad to have you back for episode 2, which you may recall is a deeper dive on the introductory video that we saw earlier in the week on risk assessment and risk management. So taking that deeper dive into risk assessment, we need to start with the concept of risk management. And I can recall in my years as a Chief Compliance Officer, our team would get up on stage from time to time and give our spiel. And as part of that spiel, we would ask who is responsible for risk management, and then the fingers would always go back at us. And we would say, no, really risk management is everyone's responsibility. And over the course of the last many years, the audit profession in particular has laid out what we'll call the 3 lines of defense. With the first line of defense being those involved on the front line. So in the case of a trust company, that would involve those who are responsible for the administration of trusts, as well as those responsible for the investment of trusts. They're the folks with the client contact who are going to be very aware of the things that are working appropriately and those where some risk might exist. The second line of defense, as many of you know, is the compliance portion. So compliance function oftentimes is within the trust company or trust department, and so is maybe a little bit more independent than being at the account officer level, if you will, but still not perfectly independent. But that line of defense really works on performing testing to see if activities within the trust company, trust department are being performed in accordance with policies, procedures, and in compliance with applicable laws and regulations. The third line of defense is the audit function, seen as an independent function and one that would be able to point out issues, particularly opportunities to improve controls, where that might not be the specialty necessarily of the compliance area. So to get the buy-in of folks on the front line to be forward and to mention those things that they saw that were concerns, I always like to use the baseball analogy, where you typically have an infielder that when the ball is hit toward a particular infielder, there's always another infielder that makes their way over toward that infielder, gets behind them in case the ball goes through their legs, and they can capture it before it goes out into the outfield and becomes a base hit or an extra base hit. So we kind of talk through it that way to build some confidence in that front line that if they come to us in the compliance area or the audit area and they share their concerns, that they're not going to get shut down, they're not going to get in trouble, that we're all working as a team, hopefully through those 3 lines so we don't have any issues that result in litigation or examination issues that end up in a report and that might be unfavorable. So those are a few things on the risk management side I wanted to share. Risk appetite is another. Larger institutions are responsible for having a risk appetite statement. Even for those of us that have not been associated with shops that were large enough to require a risk appetite statement, the regulators still consider that a risk management best practice and could cite a safety and soundness comment if they felt like the institution, regardless of its size, hadn't defined risk appetite. So let's talk risk appetite. When we talk about risk management, I always say, should not be equated with risk avoidance. That to be a competitive company and to be an ongoing concern and to be profitable, we need to take reasonable risks to compete and to survive. So it really comes down to finding that sweet spot, if you will, on the risk continuum, how much risk we're willing to take. And every shop's going to be a little bit different. But that risk appetite statement is going to guide the decisions that the financial institution makes. And then when we get around to performing risk assessments, it's going to help us be able to compare the results of the risk assessment to our risk appetite statement and determine which risks we're willing to accept, which we are going to avoid, and which ones we might share or transfer. And we'll talk about that a little bit later. But what is a risk assessment? A risk assessment really is looking at adverse events that could affect a financial institution, coming up with a rating and a prioritization of those risks, and determining which of those risks could have an adverse impact on the financial institution and its ability to achieve its strategic objectives. We talked the other day that there were many types of risk assessments that could be performed. They could either be general risk assessments, they could be based on product line, like say in the trust business, personal trusts, employee benefit trusts, corporate trusts, managing agent accounts. Could be on process, so it could be on a process for initiating a discretionary distribution. It could be for the wiring of funds out of the institution. So looking at each of those functions, not only to find places where fraud or violations could occur, but also to try to identify opportunities to improve efficiency. We talked about targeted risk assessments, and I think I gave the examples of anti-money laundering risk assessments, information security risk assessments, also required risk assessments for identity theft are included in that mix, so those would be important. Some will go about performing a compliance risk assessment, so it might be literally for an OCC chartered trust department of a bank or a trust company to work down Regulation 9 and other applicable regulations and just say, here is the standard, how is the institution doing with regard to that standard? When it comes down to methodologies for risk assessment, there is no one-size-fits-all. It could be that in a small and very non-complex shop, it could be as simple as folks getting together who are knowledgeable and putting together what I would call a sticky note risk assessment. So it could be as simple as saying, give me a list of 3 things that keep you up at night, and then come up and post those on the board. And then when that's done, kind of grouping them into categories so that you could look at a risk issue from a category perspective, and then perhaps take the deeper dive. At some companies that I worked for, the process was often initiated by performing an anonymous survey. Some folks weren't willing to speak up and share their thoughts, but they were willing to do that in a survey. So we would gather information on those kind of things, let's say in a general risk assessment, that were the things that would keep people up at night. And then we would group those into categories, not unlike the sticky note exercise that I mentioned. And then once we had those all assembled, we would create at least one team, maybe 2 teams, cross-functional groups of associates, so that you had folks from, in the trust business anyway, you had folks from administration, investments, tax, new business, operations, and the like. And you'd sit down and take a look at each of those adverse events that were identified during the survey, and essentially say, what controls do we have in place, first of all, that might prevent those events from happening or becoming a catastrophic event. We would take that data into place through a first meeting of this cross-functional group of associates. And then when we regrouped for the second meeting, we'd sit down and say, okay, let's go ahead and evaluate this risk, or in other words, score or rank the risk. So there are a few high-level terms that I'd like to share. One is inherent risk. So we want to determine on any of these adverse events, what are the risks, what is the inherent risk of a certain activity or adverse event? And inherent risk is the amount of risk that's present without considering the controls in place that might help to limit that risk. So theoretically, if you got 10 trust companies that were similar in structure and they came up with the same list of adverse events, they ought to be able to sit down and rate those from an inherent risk standpoint, and I would think that the risk would be very similar across all those institutions. The differentiating effect would be the quality in terms of the quality of the control and the application of the control in helping to reduce that inherent risk. So essentially what we did, without going into too much detail, we would look at the categories of risk that the federal regulators came up with respect to trust and fiduciary activities. So some of those would be strategic risk, reputation risk, legal and compliance risk, operational risk. And we come up with scores under each of those headings for the consequence of the adverse event that we were evaluating. We would also then look at the likelihood of that event occurring, and without going into too much detail, go through a calculation where we would come up with the inherent risk for that particular adverse event. We would then go about scoring the controls and the effectiveness of those controls and come up with a number or a control score, which we would apply to eventually calculate a residual risk score, which again is the amount of risk that's present after controls are considered. Based on that final list, we would rank them from the highest residual risk down to the lowest, with a focus on those residual risks that were the highest risk. But we would also take a look at some of the inherent risks that, while they might have been well controlled, were high inherent risks. Obviously, we have turnover from time to time, changes in processes and policies. Sometimes folks don't read the memo, don't get the memo, don't understand the process. And so something that effectively controls or reduces risk today may not do the same thing years from now. So we want to look at those things that are maybe well controlled today, but if they shouldn't be well controlled sometime down the road, that they could turn into a big problem for us. So how do we go about using the results of a risk assessment? The first thing that we would do when we finish is look at those risks that we have as the most significant, and we would compare them to the risk appetite statement that we have and figure out, is this something, again, that we're going to accept the level of risk that we have and just go on as if nothing ever happened? Are we going to mitigate it completely by discontinuing that process or that line of business? Or are we going to choose something in between where we might even share that risk with someone else? So that might involve getting involved with an insurance carrier who would help to assume a certain level of that risk. Maybe we would be responsible for the deductible and they would cover anything over the deductible. So there are a lot of ways to work through that process. So that would be kind of the next thing we would do. And then we would work with a risk and compliance committee or the trust committee if institution didn't have a risk and compliance committee to figure out which of those risks would be further reviewed and perhaps mitigated. Some of the benefits of the risk assessment that we talked about in the trust business, the regulators don't require by regulation an administrative review to be performed, but they consider it a best practice or from a risk management perspective to perform generally an annual review of the administration of all accounts. The regulators are seeing more often and are getting more comfortable with and are more pleased with situations where the trust officers who administer the accounts aren't reviewing their own accounts. I worked for a shop that made that change back in the day, and so where you might have had 15 or 20 account officers performing the, say, 5,000 account reviews during the year, which could be reasonable, we went to a situation where members of our risk and compliance team were, three members were responsible for reviewing those same accounts. So what we did is we effectively performed a risk assessment, and we went to our regulators and we said, we've kind of segregated these accounts into buckets. Certain accounts are going to require an annual review for certain. Others, a more frequent review based on the risks. And on the other hand, there will be accounts that maybe we could go out 2 or 3 years because there just aren't those same risks present. So we laid out the proposal, took it to our regulator, and they said, as long as you're not going more than 3 years without performing an administrative review and you're basing it on these risk factors that you've come up with as part of the risk assessment, we think that's reasonable. So now you could have 3 people performing the work that maybe 20 people had to perform before. It wouldn't have been reasonable to hire a number of new people onto the risk and compliance team to perform those reviews. So that is an example of a situation where we were able to make the account review process scalable based on the results of our risk assessment. Risk assessments also become very important because they form the basis for the scope and frequency of audits and compliance testing. In today's world, at least with respect to Regulation 9 of the Comptroller of the Currency, you can perform annual audits of your trust activities or continuous audits. In the companies I was in, we were of sufficient size that we would go through a continuous process, which means that you might not get to everything in 1 year, but you would base your audit schedule or your compliance testing schedule on the risk level of the different activities that might be involved. So if it's something like trust administration, if it's discretionary distributions, if it's investment-related matters, maybe those are things that are being looked at every year. And then maybe there's an activity that's a lesser risk that maybe you could push out 3, 4, or 5 years. You have to hit it at some point, but we were able to work with our regulator to come out with buckets, if you will, time frames where those things that were more critical were reviewed every year and those that were less critical were pushed out on a longer term basis. Another item that of course is near and dear to our regulators' hearts is anti-money laundering. And of course there's a requirement as part of the anti-money laundering rules to perform a risk assessment. And so if I'm a trust company that administers irrevocable trust accounts, and I have to make decisions as a trustee with discretion whether to make those payments out from the trust and to see whether they meet the terms of the trust, I'm going to know an awful lot about that transaction and whether or not it's appropriate. Let's say that all my clients are domiciled in the United States. I have even a better comfort level that the types of transactions that I'm doing are less likely to be problematic. Not completely free of risk, but maybe a lower risk than what you would typically think. Where if I'm a larger shop and maybe I'm in investment management agency accounts where the client calls and they said, hey, I'd like to have a distribution of $200,000 to make a payment out of my account. Certainly as a trustee we could ask the reason for that distribution, but the client's under no obligation to meet a standard like you might have in a trust agreement prior to making a discretionary distribution. Again, you might have clients outside the country, and you might have certain types of transactions in terms of their size or their frequency or their nature that would cause you concern. That from a risk assessment standpoint, you might say in a more complex shop, you're going to have a more robust process in terms of the scope and nature of your anti-money laundering program, which would include the process of reviewing activity in the accounts, suspicious activity, for review. The only other thing I thought I would mention is for investment advisors. Investment advisors under the compliance program rule are responsible for developing policies and procedures that are reasonably designed to prevent violations of the federal securities laws. Also responsible for having an annual review of those policies and procedures to identify any gaps, and also to have a competent and knowledgeable chief compliance officer who's empowered to carry out their responsibilities. So as part of that annual review process, you're really comparing your policies and procedures to your operating practices, and at the end of the day saying, are there any gaps there? Any business practices or types of products and services that we're engaged in that we haven't laid out in our policies and procedures. We'd also talk about any conflicts of interest that might not be addressed by those policies or procedures or disclosures. And so that would be part of a risk assessment process that might accompany the annual review. I thought that I might mention something that the SEC has put out called questions that advisors should ask when establishing or reviewing their compliance programs. And that's something that you might want to take a look at out on the internet. The SEC has that resource available for you. And I also have some resources available for you on the investment advisory side if you have an interest in knowing some of the things that you might want to take a look at when you're performing a risk assessment for an advisory firm. So hopefully this information has been helpful to you. And if you have any questions, I encourage you to reach out to me. I'll provide my information on my LinkedIn page. Don't hesitate to give me a call if you want to talk through the process. We've done this for quite a long time and believe we have some information that can help you. So thanks for joining us today, and we'll be back with a new topic for you next Tuesday.